Let's start with that SALT deduction because it just came up. Can you explain that, Bryan? What is this SALT deduction?
Yeah, so the SALT deduction was one that even if you're not a tax nerd like me, you probably read about it at some point or heard about it on social media. It was just this big sticking point between the politicians. So historically, property taxes are deductible. In 2017, if you had a primary residence and you paid $20,000 in property taxes, the 2017 tax bill said you can only deduct 10,000 of that. So now the rule is $40,000 of state SALT is state and local taxes, right? Mm-hmm. So your primary residence, if you have $18,000 worth of property taxes, it's subject to, like with anything, it's subject to some phase outs, but you can now deduct $40,000. The phase outs are around $500,000. So if you make $500,000 of income, you're kind of underneath the old 10,000 rule. But if you're at 350 and you have $15,000 worth of property tax, well, you're going to feel that. You're going to get more deductions this year on your tax return than you did in the past.
Quick question on the auto interest deduction. Can you explain what's going on there?
Historically, auto interest has never been tax deductible. Well, now there's a separate form that if you have interest on a personal vehicle, the interest can be tax deductible. And there's phase outs like with anything. And so there's phase out if your income is between 150 and 250. So if you make $260,000 worth of income, not going to benefit you. But if you make 100,000 and you have a vehicle with interest, now again, there's more rules. The property has to be required and assembled in the United States. If you make over 250, it's not going to qualify. So there's all types of rules. I put it in there because it is a hot topic that we're reading about. And I guarantee you when we're filing tax returns, we're going to get this over and over and over.